So today's topic is project appraisal and risk, chapter number 7. So first you are going to learn about risk and uncertainty. Let me give you some details about risk. So what is risk? See, risk is something like I can say what you expect and what you really get. The difference between those two is because of the element called risk. That means you're expecting 10% returns from your investment. You got 12% returns. This extra 2% is only because of the factor called risk, right? So risk, they say that it is some adverse condition, or like it can cause it is some harmful thing which can be associated with a task. Okay, but I always say risk is not always harmful. See, sometimes you get very good rewards by taking higher risks, right? You get very good returns when you take higher risks, and so that time it is not bad, it seems, right? But if you incur big losses, then you say it is something which is harmful. So in my context, what I really can say you is what you expected here was this. This was certain thing what you expected, but you got this. This is because you took some extra risk, okay, and henceforth you got these extra returns. Because if you take a higher risk, you definitely want to be compensated by getting more returns for taking that higher risk, right? So risk is a factor which can deviate the returns. So I can say if this is a normal distribution curve, this is 10% what you expected. So if you get 12% or if you get 8%, more risk, more returns, less risk, less returns. So the variance or the variation from the mean or deviation from the mean is nothing but because of the element called risk. And it can, so risk is something because of which this is happening. There are different types of risk because of which this deviation can happen. Okay, so we are not learning about different types of risk or something like that. Just we should have a little knowledge of risk. That's what is more important. So you should understand that whenever you're investing in a project, if you are expecting higher returns from that project, that means you should take higher risk. Less returns, less risk. That's it. Okay. And uncertainty is something for which no one has an answer in the world. Uncertainty can hit you any point of time. COVID-19. So anyone did anyone like expect coronavirus is going to come? A normal man? No. So that was an uncertainty. Earthquake, uncertainty, right? So the point is risk is something which we know is always attached to whatever activity we perform or whatever business we do or whatever activity we do. Henceforth, we know that risk is always there in something. Okay, if you finish your education, then you decide that you want to start a practice firm. That means you want to be a practitioner. There's a risk. So immediately you may not get clients. It may take a lot of time for you to build your relationships and make your clients. So what is happening if you take a job, you immediately get your package. But when you have a firm, you're independent, you're a freelancer, and you can have the clients, like you can have so many clients. There's no limit to that, and then you can have good rewards in the future, right? Like I know, like no, it's not for rewards you're doing, it's for serving the society. But like more clients, you can earn more in the future, right? So since you're taking a higher risk of practice, you can definitely get more returns. In the sense, more earnings you can make. You're taking less risk and doing a job, you have limited package or salary, right? So I think you understood what is risk and what is like uncertainty. So there's a definition given here. And in investment decisions, risk is an important factor to be considered. Risk and uncertainty, right? So risk arises where there are several possible outcomes. Yeah, there can be. See, when you expected 10% returns from a project, you can get 12%. You can get different outcomes, right? You can get 14%. You can get 6%. There are different outcomes, right? So several possible outcomes, and based on the past relevant experience. So past relevant experience from that particular stock, what you have taken, you can say that you will get 10% returns because it has delivered 10% returns many times. Like it has been delivering 10% returns on an average. See, mean is what? Mean returns means what? On an average. So risk arises where there are several possible outcomes. Here you can see based on past relevant experience, probabilities can be assigned to the possible outcomes. That means the chance of getting 12% returns is, let's say, 30%. So there are 30% chances that 12% returns you can get, and there are 80% chances that there can be 8% returns. That means you will be incurring 2% loss. Okay. So this is what is risk all about. So simple statement, risk increases as the variability of a project's cash flow increases. Of course, risk can be quantified and built into a NPV. Okay. Uncertainty, I already told you that there's no answer for uncertainty. This can crop up any point of time. Cannot be quantified. Now, risk analysis. So here we understood that for any returns, what you expect some returns, right? You get more or less than that. There can be a probability for that to happen. So we are going to assign probabilities now, and we are going to find out our NPV, right? So you can see an activity. Harry Company is choosing between two mutually exclusive projects. Mutually exclusive project in the sense you cannot take two. You have to only pick one out of these two, right? That is called mutually exclusive. That means if you have a car, you want to take a turn, you cannot take right turn and left turn both at a time. You can either take right turn or left turn. That means only one thing can be possible here. Now, so Harry Company is choosing between two mutually exclusive projects. The NPV of these projects is like in $1 million, depends on the rate of growth of economy over the next 5 years. That means if you want a positive NPV, definitely the economy should boom, and your NPV depends upon the growth in the economy, right, in the coming 5 years. Forecast NPV is shown under scenarios of low, medium, and high growth. So there is a 25% chance that there will be a low growth, okay, and your NPV is going to be $1 million, okay, in project A, and negative $8 million in project B, big loss. 50% chance that there's going to be medium growth in the economy. This much you can expect from project A, and this much you can expect from project B. 25% chance again high growth, that there can be there's a 25% chance that there can be high growth, and this much is what you can expect from both the projects. And you know the expected value they're asking you. So what is the formula for expected value? Probability expected value is nothing but summation of probability into observation. So PIXI I would say. That means P1x1 plus P2x2 plus P3x3. Okay, this is called expected value. So how will we find out? Very simple. You have to take the probability 0.25 into, for project A we are doing, into 1 plus 0.50 into 2.50 plus 0.25 into 4, right? And this same thing you have to do for B and tell me the answer. Come on, fast. I'm waiting for the answer. Okay, fast. Tell me the answer for this and as well as for that. So I'll write here 0.25 into minus 8 plus 0.50 into 4 plus 0.25 into 16. Okay, tell me the answers. I'm reading. I'm asking to do this question. I'm waiting. See, if you are not answering, then I don't understand. Sorry.
Is it 8?
First one, no, like 0.25 into 1 is 0.25. Plus 0.50 into 1 into 2.50 is 1.25. 0.25 into 4 is 1. 1.25 plus 0.25 is 1.50. 1.50 plus 1 is 2.50. Do the second one.
The second one, sir.
What second one? How? minus 8 into 0.25. You should take 4 parts of this. Minus 2 plus 2.
4,
0.50
sir.
into 4 plus
Plus
4.
4.
4. Yeah, answer is 4. Okay, this is the expected values.
Yes.
This activity is done. Now risk and joint probabilities. So a probability distribution. So I showed you a normal distribution curve right now with 10 and like 12, 8. It's a probability distribution. Probability distribution is nothing but for every outcome there will be a probability. If I say, if I'm tossing a coin, okay, there is going to be a head and there is going to be a tail. Fine, this is the outcome. There's a probability for this 0.50 and 0.50. That means 50-50, right? So this is a probability distribution. If I show this in a table, so a probability distribution. So probability that this is nothing but the outcomes with their probabilities are shown. It's a distribution. So a probability distribution of expected cash flows. So what I mean by expected cash flows, by taking the probabilities and the cash flows, multiplying them, I get the expected cash flows. If I add up all those probability, the sum of the probabilities and the outcomes, the product of the sum of the product of probabilities and the outcomes, the sum of the product of probabilities and outcomes. So if I get expected cash flows, can also be used to measure risk. For example, by calculating the worst possible outcome and its probability, calculating the probability that the project will fail to achieve a positive NPV. So what they are asking, so a probability distribution of expected cash flows can be used. Why are we using this methodology? To measure the risk. How? By calculating the worst possible outcome and its probability. Like what is the worst possible outcome and the probability of that worst possible outcome, or calculating the probability that the project will fail to achieve a positive NPV. So failing to achieve positive NPV is also a worst possible outcome only. So this may involve analyzing the risk of single outcome. Example, the 25% risk of project be failing to achieve a positive NPV in the previous activity. Yeah. So this was the thing, na 25% that it's going to fail because it's going to get a negative NPV here, right? So now instead of reading this all things, alternative risk may be measured by analyzing the risk of two risky outcomes. So we are going to take two outcomes and we are going to see the risk of that occurring at the same time, and we can use joint probability methodology for that. Joint probability is nothing but you're going to take you're going to take two probabilities and you're going to, join them, multiply them to get the joint probability out of it, right? So now there is a question here in front of you, and we will do this question and understand what's happening here, right? So how to use this joint probability methodology you're going to see, and you're going to also find out the NPV in this case. It's a very, very simple way to do. So there's an investment in a project, in a product. So an investment in a new product is being planned, right? An investment in a new product is being planned. The product has an expected life of 2 years. So there are, like you are considering to invest in a new product, it seems. And the product has an expected life of 2 years, it seems. An analysis of similar projects has resulted in the following annual cash flow projections. So you you want to invest, right? And you want to invest in a new product. You're planning to, invest in a new product. Product means you want to make a new product, it seems. And the product will have a life of 2 years, right? So, if you want to invest, you need to check some similar projects of that kind and see how the annual cash flows those projects have got, or the projections you have to see. So cash flow projection, that means there's a high probability that $56 million per annum is the cash flow going to be in the year 1, and the chances of that is 60%, and in year 2 the cash flow projection is going to be $44 million for that year, and there's a 30% chance of that. Here also the chances and the cash flow projections are given. The outcome in year 2 is not dependent on outcome in year 1. That means there is no dependency. These are independent events, not dependent, right? Setup cost of $77 million are payable immediately. This is the investment. Cost of capital is 10%. You are the management accountant and you are worried about the risk of the project. Come on. So see, if it's a negative NPV, we will not take. It's a positive NPV, we will take. But you know, the probabilities are given when we need to work out this and we need to see how to do this question. So once again, read this. We'll go ahead. Okay. So the possible outcomes have been further analyzed as follows. Year 1, year 2 and the NPV is also given. You need not do any calculation. They themselves have given. Year 1, like 44 million. There's a less chance. Okay, 44 million the negative, and see, if year 1 cash flow is going to be this and year 2 cash flow is this, the NPV is this. Again this, that means low chance of this happening, high chance of this happening. NPV is this, high chance of this and low chance of this. NPV is this, high chance of this and high chance of this. NPV is this, right? So you need not take any taxation here. What we are going to do, we are going to take all the combinations, like year 1 low, year 2 low, year 1 low, year 2 high, year 1 high, year 2 low, year 1 high, year 2 high, right? And what we know about the probabilities of year 1, year 2. So we are going to take the probabilities. First one is year 1, right? Low. What is the probability of low in year 1? What is the probability?
40%.
40%. So I am going to take that probability here, 40%. Okay. And year 2 low. What is the probability?
70%.
Yeah, year 2 the low probability is 70%. So I'm going to take the joint probabilities. Okay, and I'm going to take that way. And again I'm going to take the low and high. Low is 40 and high is 30. Okay, in year 2. High and low. High is 60 and 70, and high and high it is 60 and 30, right? You can see this. High and high. All the joint probabilities are here, and some of the probability should be equal to 1, you already know. You take those joint probabilities and multiply with the NPVs given to you, and then you find out the sum. You still get a positive NPV. Then definitely it's a good project, right? Yes or no? Did you follow this?
Yes.
Hello. Yeah. So do this right now. Then alternative method also we can check. Alternative calculation. This is what you are going to invest, right? You're going to do the investment of this. What are the cash flows you are expecting? The cash flows what you're expecting is 5644, and then you have the probability of that as well. Multiply with the probabilities. 56 0.6, 44 0.4. This is in the year 1. We are going to take year 1 wise. So year 1 56 million per annum and the chance is 60%. Year 1 44 million per annum, okay, and 40% chance. So we are going to multiply the cash flows with their probabilities. This is the method what we followed in the first illustration. Whatever you find easy, you can take that. 56,000 into 0.6 and 44,000 into 0.4. Then again for year 2, 44,000 into 0.30, 36,000 into 0.70. Okay, you're going to get the sum, and then you're going to discount them. You're going to get discounted cash flows. You're going to add these cash flows, and you're going to subtract this. You're going to get the positive NPV. So I think the alternative 2 is something which is more traditionally we know, right? So this is also a method which you can follow. I would recommend you to go for alternative 2, which I think is very, very simple way to do. It's your wish, whatever you want you can do. Both the methods you can follow, right? Come on, do this. We'll move forward fast.
So how come this discount factor is decided, sir, on 60%, 40%?
No, discount factor is given to you, na 10% in the question. Cost of capital.
Yeah, okay, sir.
That's it. Once done, tell me. Yeah, it's done.
Yes, sir.
Okay. So there is an activity given to you. What they're asking you, using the information from the previous illustration, identify the probability of the project having a negative NPV and give your answer as a percentage to one decimal place. Identify the NPV of the most likely outcome. So what you can say? So they are asking you, identify the probability of the project having a negative NPV. So we are going to see the project with negative NPV, right? So what was the project with negative NPV here? The project with negative NPV was what? Minus this is the negative NPV they give, right? What were the probabilities of this? The joint probability which you found out?
40%.
0.28 and the second one was 0.12, correct? For this
Yes,
also there was
yes.
negative NPV, correct? So 0. Low. It was 0.4 and 0.7. 0.4 into 0.7. 0.28. This was for the first year and second year combined, right? And the second case, these were the cash flows with which gave negative NPV. Low high. The low high probability was 0.40 and 0.30.
0.
0.12. And if I take the total probability of having negative NPV is like 0.40, right? It's like 40%. Come on, do the second question. So I did the first one for you. Okay, second one. Identify the NPV of the most likely outcome. What do you mean by most likely outcome?
Positive outcome. 60%.
No, it's not like that. The most likely outcome in terms of highest joint probability. We have to take the highest joint probability. Most likely is highest joint probability, right? So
0.42.
0.4. Just a second. Yeah, that is 0.42 because this is giving me the highest probability, correct? So just a second. So I will take this, and for this most likely outcome will be what? 3640, right? So the answer is 0.42 is the highest probability and the outcome is 3640 positive NPV. So we are done with this activity. Shall we go for the next one?
So once scroll it down also. This question of 0.3
Scroll down or
36.
scroll up?
Scroll down. Like I want to see this table, sir. 3640 where it is given.
So I shall scroll up, right?
Ah.
Yeah.
Okay, sir.
Yeah, the probabilities are also given here. So the point is, what are the problems with this analysis? There are a number of problems with using expected values in making investment decisions. An investment may be one-off, that means you'll be doing it one time, and the expected NPV may never actually occur. Yes, because you are just assigning probabilities. You are saying that there are 50% chances that this can happen. But do you think whatever you estimate is always going to be exactly what you estimated? See, you
No, sir.
estimated that there will be a positive NPV, but there can be a negative NPV as well. Anything can happen, right? There's no certainty to what you estimate. Assigning probabilities also, for future events is highly subjective. You are just estimating. Your estimations are approximations or just an estimation. You cannot say that it's going to happen definitely. Expected values do not evaluate the range of possible NPV outcomes. Yeah, you just put that 25% things can happen. But exactly there can be anything, not 25.1%, 25.2%, right? There can be any possible NPV outcomes. If a company, so for this percentage, do you think there is only going to be $1,000 as NPV? There can be any value. If a company has a neutral attitude to risk, it can be assumed that it will select an investment that is forecast to create the highest expected NPV. However, if a company is especially risk averse, so there are three types of people you see in real life: risk averse, who want very high returns at very less risk; risk neutral, who are okay with high returns or low returns for any given amount of risk; and there is risk seeker, who wants to take very high risk and who wants to get very high returns because he's taking high risk. So if a company has a risk neutral attitude to risk, it can be assumed that it will select an investment that is forecast to create highest expected NPV. Yeah, he's indifferent to high or low, whatever. He's okay with this. But if you see risk averse investors, or if risk seeking, then companies decision making will be influenced by their risk appetite. That's what. Risk averse will always want high returns. He by default wants, and risk seeker, since he's taking high risk, he will expect high returns only. Okay. Other techniques for managing risk is simulation. Okay. Simulation and conservative forecasting. What is simulation? Have you ever seen a simulator? A simulator is a replica of something. When you go to some mall and you see some bikes, the kids are, riding some bike and they are seeing that on a computer screen. And whenever the bike on the screen hits something on the road, there's a vibration in that particular replica of bike on which the kids are riding. That gives them a real-time experience. That's a simulator. So simulation is a technique whereby you just assign values and you try to check what are you getting out of it. Okay. So you do that many a times, fine, to check what is, so that means you are beforehand trying to estimate what is the NPV going to be with different permutations and combinations or different kinds of cash flows. Okay. But really speaking, like simulation is what we are not going to learn like in this particular syllabus. You are going to learn that in AFM. So don't expect any questions from simulation. But still that we are going to read this. Random numbers are assigned to different values of variables to reflect their probability. Random number means you are going to put some random numbers. Random numbers you are going to assign. For what? For different values of variables to reflect their probability. Variables is what? Some things because of which the NPV can be impacted. Selling price, or these are called variables. Discount factor, etc. Risk is assessed as standard deviation of forecast NPVs. So whatever the risk you are going to study, standard deviation is the measure to study that. For repeated simulations, for different kind of outcomes what you're expecting, and the probability of a negative NPV. So they are saying that you are going to assign random numbers to different value of variables to reflect their probability. Risk you are going to study with the help of a statistical technique called standard deviation. Then you're going to forecast your NPV based upon the repeated experiments you do or repeated simulations, and the probability of a negative NPV you're going to see. However, because the random numbers are based on probabilities, there is a danger that they may be highly subjective. That's what, again, it's a probabilistic approach. Hence, all the random numbers what you're going to put is like based upon your own choice, because random numbers are random, not something which you already know and you're going to assign. No, it's random. So you cannot always trust this technique for finding out your NPVs, right? And then conservative forecasting. That means traditional way of dealing with risk is to reduce estimated project cash inflows to an ultra safe level. That means called certainty approach. Certainty approach is nothing but you are going to see that you are going to get some cash flows, like however. Okay. For example, if I'm investing in treasury bills, that is United States government securities, I'm definitely going to get the returns in that. It's a certain return giving investment option. In the same way, what you're going to do is a traditional way of dealing with risk is to reduce estimated project cash inflows. That means you're going to reduce your cash flows to very low levels, and you know that much you are definitely going to get in worst case scenario as well. So these cash flows are then discounted as if they are risk free using a very low or risk free cost of capital. So example, let's say I am expecting 10,000 is what I'm going to get, but I really know that definitely 5,000 I will get. Okay, 10,000 I estimated or expected, 5,000 I will surely get, I know. And then what I did is I am discounting this with 3% as discount factor. This is the risk-free rate prevailing in the market, or treasury bills giving to me if I invest in treasury bill. This is sometimes called a certainty equivalent method. There is a danger with this technique that the likely benefits of investments may be understated. That means maybe you may get this much, but you're trying to keep it as low as possible, as safe as possible. And do you think you are always going to expect risk-free rate from a project? That is again a blunder. That means project can have high risk and high returns are expected. You cannot like always expect that you are going to get this surely, definitely, but always restricting ourselves to this is not something which an investor will be doing. Okay, with there is a thrill in taking risk. Without taking risk, you are like someone, why you are doing a business activity then. Finally, later in this workbook, chapter 12, we will see how a cost of capital can be adjusted to recognize that investors will want a higher return on riskier projects. So I will explain you CAPM model and other models to understand this concept. Okay, this is also called as risk adjusted cost of capital. I will explain you all this. Don't worry about this. Okay. Now, next topic is sensitivity, uncertainty analysis or sensitivity analysis. Okay. So, okay, just take 2 minutes of time and read this. Very important points. Any doubts you may ask, and then we are going to go into the next topic called sensitivity analysis.
Sir, so the discounting factor would be applied on this example 5,000 or 10,000, sir?